we are covering policy loans and the automatic premium loan provision for the national portion of the life insurance exam. It is essential to recognize that a policy loan is not a withdrawal of the policyholder's own money, but rather a loan issued by the insurer using the policy cash value as collateral. This distinction is vital for the exam because the cash value continues to earn interest even while a loan is outstanding, though the interest earned may be at a lower rate. You must remember that the insurance company charges interest on these loans. If a policyholder dies before the loan is repaid, the outstanding balance plus any accrued interest is deducted from the death benefit. For example, if a policy has a face value of $100,000 and a $10,000 loan, the beneficiary will receive $90,000. The automatic premium loan provision, or APL, is a secondary layer of protection against a policy lapse. It is designed to step in if a premium is not paid by the end of the grace period. The insurer will automatically create a loan against the cash value to cover the premium amount due. This ensures the policy stays in force and the coverage remains active. A crucial point for the exam is that the APL only functions if there is sufficient cash value to cover the premium. If the cash value is empty or insufficient, the APL cannot trigger and the policy will lapse. When you are sitting for the exam, you need to be wary of questions that try to apply the APL to term insurance. Term insurance lacks cash value, so an APL is impossible. The provision is most common in whole life insurance. You should also be aware that the APL is typically an optional feature that the policy owner must select. It is not an automatic requirement for every policy issued. If the exam asks when the APL activates, keep in mind that it occurs at the end of the grace period. It does not replace the grace period, but rather serves as the final solution to prevent termination once that period ends. One common trap involves the total amount of the loan. If the total loan balance plus interest grows to a point where it exceeds the total cash value of the policy, the insurance company will terminate the contract. However, the insurer is usually required to provide a 30-day notice to the policy owner before this happens. Make sure you look for that 30-day notice period in your practice questions, as it is a frequent point of testing. To help you remember how this works, think of the phrase APL stands for Added Protection Against Lapse. This reminds you that its primary purpose is to keep the policy alive when a payment is missed. You should also remember that because the APL is a loan, it also reduces the death benefit if it is not paid back. The exam may also ask about the tax implications of policy loans. Generally, policy loans are not treated as taxable income because they are considered a debt. However, if the policy is surrendered or lapses while a loan is outstanding, the loan amount may be treated as a taxable distribution to the extent it exceeds the policy owner's basis. This is a more advanced concept, but it is worth noting for the national exam. Always look for the relationship between the loan balance and the death benefit. If you see a question about a policyholder who forgot to pay their premium but still has coverage weeks later, they likely had an automatic premium loan provision in place. Just ensure the policy being discussed is a cash value policy like whole life. Universal life policies also use cash value to pay for the cost of insurance, but they do so through a different mechanism involving the internal cash account rather than a formal APL loan provision. Focus on the fact that an APL creates a debt that must eventually be settled either by repayment or by deduction from the final payout.